In terms of corporate bond buying, a big story the past 24 hours, the Fed's taken the step to buy individual corporate bonds. Were you surprised at sort of the pushback? People saying, well, the Fed, doesn't really need to be doing this. In fact, Senator Toomey, Republican from, I believe, Pennsylvania, speaking to Chair Powell today, raised this point. Why do you do this? Why do you need to do it now? Were you surprised about that? Or do you think there's something to that this is a step the Fed doesn't need to take? It's a fire that's not burning yet, doesn't need to be put out.
I wasn't surprised. And the reason is because the markets are functioning reasonably well right now. Risk assets, as I don't need to tell you, have rallied substantially. Spreads are not where they were, but they've tightened. And so the challenge for us at the Fed is going to be to balance supporting market function, but also, on the other hand, showing restraint where market function is going well. So I think that's a tough judgment. And so, no, I'm not surprised that there's some criticism, and we're going to have to, my own view is we're going to have to weigh that balance.
I've got a couple other tools I want to get quick comments, because I know that you're not a fan of negative rates. Now you're on a Coach Lakota, former president of Minneapolis Fed, had an opinion piece on Bloomberg this week, and he said you guys are making a mistake. That negative rates would boost employment and help businesses and put money, would encourage lending to go out from banks or people to invest where they could make money. He said that by not doing this, you're favoring banks over people. What's wrong with that argument?
My concern is, first of all, when I look at the performance of negative rates outside the U.S., for me, at least, and I've studied it as carefully as I can, the jury's out as to how effective they've been and whether they've actually helped growth. In addition, there are side effects to negative rates, and that negative impacts on the financial system. Also, we have a very large money market industry in this country, and many companies access commercial paper, which depends on a healthy money market industry. Okay. And my concern is negative rates may wind up doing more damage and have more side effects, and it's not as clear to me what the benefits are.
Okay. I want to ask you a similar question about yield curve control. You're open to it, but when you were talking about this week, you mentioned that it could distort signals from the market. A lot of people are saying, yeah, a steepening yield curve, an inverting yield curve, can send everybody a message, policymakers included. You said that could happen, right? So why would you even consider going for a policy that is going to destroy market signals that you yourself say are so important?
So as I've said, I'm skeptical about yield curve control, and at the moment, I need to be convinced of the reasons for it. Having said that, what could happen is we've got a substantial amount of government debt that needs to be issued, and we had a substantial amount before this crisis. It's now gotten exacerbated. And as we're in this crisis, while we're still in it, if I saw some evidence that Treasury yields were being strained because of the substantial amount of debt issuance, that would be one argument that would cause me at least to want to examine yield curve control. I don't see evidence of that right now, which is the reason why I'm skeptical, but I want to be open-minded.
How does China's economy look to you right now? And is it your sense that to have a true global recovery, we have to see not just the U.S. leading the way, but also China? And where are they in terms of their challenges with the virus? Some cases rising again, some taking steps to stop that, the trade tensions that exist, supply chains being shifted in a lot of cases. How does China look to you?
China is on the bright side. They are recovering, and the industrial sector has certainly recovered. The consumer sector is having a number of the issues that we just talked about. Consumers' willingness to re-engage in a broader range of activities. They're spending, but there's certain things that they're showing a reluctance to do, and we see that in the data. And in addition, as has been well reported, they have also outbreaks, but they have very good testing and contact tracing, so they're able to localize it and address it locally very quickly. So I'm optimistic about China's recovery, but I would just note For those who watch economies outside the U.S., for example, Europe, Germany, Germany's GDP growth will probably do worse this year than the U.S. Other European countries will do worse. Why is that? They're much more dependent on exports, and China, for one, has a big impact on their GDP. And if China's weak, then European growth will be weaker. And I would say if global growth is weaker, U.S. growth is likely to have be impacted to some extent. So, but China's recovering, but they have some of the same constraints I just talked about. How widely are consumers willing to reengage? And they're having some of the same challenges that we just talked about in this conversation.
Well, we've got a viewer question who wants to come back to this question of buying corporate bonds and why the Fed has done it now or is doing it now. And I think it's a particularly pertinent one for you, Rob, because you wrote the essay last year saying, there was too much borrowing, there was too much debt at corporations, there was too much leverage, and it would just, but don't worry because it's only going to hurt the corporations, or maybe it's going to exacerbate a downturn. Is that what it's doing now? And I think, does that have something to do with this viewer question about what's the point of Fed buying corporate bonds now? Yeah. And what is the data the Fed's looking at? Excuse me, let me add one more thing. What is the data the Fed's looking at that we are not privy to?
Sure. So I said before this crisis that I thought the record amount of corporate debt would be an amplifier in a downturn. And in my view, it has been an amplifier of the downturn. And so I think it's right to be sensitive. We should do what we can in the middle of this crisis. But as we start to emerge from it, I do think it's wise. I think it's wise to show restraint in some of these actions that affect markets, because we can have side effects where it incentivizes more risk taking, more leverage, and other negative side effects, which I think are real, and we have to balance those against the needs of the crisis. As to whether I don't know that we're privy to something that no one else has seen. I think we had said we were going to take action on corporate bonds to help with market stability. We've done that, and I think we've got to find the right balance here, and I am sensitive to that concern and even criticism.
I'll ask you a question a lot of people have raised. And I ask it because I'm just amazed at the number of people who are bringing this up now, because they didn't bring it up during the great financial crisis. The Fed's been having to cut rates and take big steps for decades to boost the economy and get things going again. But now a lot of people are talking about the Fed is creating more inequality, especially more wealth inequality, more income inequality, particularly important in a time when we've got a spotlight shown on racial inequalities, groups of people who are behind and not catching up. As a man who worked on Wall Street, who's been a business management professor, who's now been at the Dallas Fed for about 10 years, how do you answer that? What do you see?
So we have a history where Black unemployment and Hispanic unemployment was higher than the overall unemployment rate. In the last couple of years leading up to this crisis, running the economy hotter, we've been able to close that gap. And for the first time in a long time, we saw the gap between white unemployment and Black and Hispanic unemployment start to narrow, and some improvement being made on this issue of wage inequality. Regrettably, as a result of this crisis, because Blacks and Hispanics have disproportionately suffered in this pandemic over the last few months, we've given back a lot of that progress, and the gap is now widened. And so there is a role for monetary policy to play, but there's also I think there are limits to monetary policy in this issue, and we've got to be conscious of that. We need, again, early childhood literacy, better educational attainment, better skills training, and a number of other targeted policies, in my view, to help close this gap. But yeah, there are side effects to monetary policy in that they can strengthen risk assets. But we saw, leading up to this crisis, I think running the economy hotter did have a number of positive effects to close this gap. And so you just got to weigh all those factors going forward and understand that monetary policy by itself is not going to address this, but we have to be conscious of some of the side effects too.